Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that is absolutely crucial for anyone serious about trading or investing: stop-loss orders. But we're not just talking about placing a simple order. We're going to explore how to weave them into a powerful, comprehensive risk management plan that can protect your capital and keep you in the game for the long haul. So, what exactly is a stop-loss? Think of it as your automatic safety net. It is an order you place with your broker to sell a security when it reaches a certain price. The goal is simple: to limit your potential loss on a position. If you buy a stock at $50, you might set a stop loss at $45. If the stock price drops to $45, your order triggers automatically, selling the position and preventing further losses if the price continues to fall. It's your predefined exit strategy for when a trade goes against you. Now, you might be thinking, why can't I just watch the market and sell manually if things look bad? That's a fair question, but it overlooks two of the biggest enemies of any trader: emotions and distraction. The market can move incredibly fast. A sudden news event or a wave of selling can send a stock tumbling in minutes. By the time you notice, react, and decide to sell, your loss could be far greater than you intended. A stop-loss removes that emotional hesitation. It executes your plan without fear, greed, or hope getting in the way. It's a disciplined, systematic approach that works for you 24/7, even when you're not glued to your screen. But a stop-loss isn't a magic wand. Just setting one isn't enough. The real power comes from integrating it into a broader risk management strategy. And the first step of that strategy is defining your risk per trade. This is probably the single most important rule in trading. Before you even enter a position, you need to decide the maximum percentage of your total trading capital you are willing to lose on that single trade. A common rule of thumb for beginners and even many professionals is the 1% rule. This means you never risk more than 1% of your account on any one idea. Let's break that down with an example. If you have a $10,000 trading account, the 1% rule means you should not risk more than $100 on a single trade. This isn't about how much money you invest, it's about how much you stand to lose. This single rule prevents one or two bad trades from wiping you out. It gives you staying power, allowing you to survive the inevitable losing streaks that every single trader experiences. So, how do we connect this 1% rule to our stop-loss? This is where position sizing comes in. Your stop-loss level and your risk per trade percentage work together to determine how many shares you can buy. Let's go back to our $10,000 account, risking $100 per trade. Imagine you want to buy a stock that's currently trading at $25. After doing your analysis, you decide that a logical place for your stop-loss is at $23. This means your risk per share is to $25 entry minus $23 stop-loss. Now, to calculate your position size, you simply divide your maximum dollar risk by your risk per share. In this case, it's $100 divided by $2 per share, which equals 50 shares. So, you would buy 50 shares of that stock. If the trade goes against you and hits your stop-loss at $23, you will lose exactly $100, which is 1% of your account, just as you planned. This methodical process ensures that your risk is always controlled and consistent, regardless of the stock's price or its volatility. This brings us to a critical point. Where do you actually place the stop-loss? Placing it too close to your entry price means you could get stopped out by normal market noise or small, meaningless fluctuations, only to watch the stock then move in your favor without you. Place it too far away, and you might be taking on too much risk, or it might require your position size to be so small that the potential reward isn't worth it. The key is to place your stop based on technical analysis, not just an arbitrary percentage or dollar amount. Look for logical levels on the chart. A great place for a stop-loss is just below a key support level, a recent swing low, or a significant moving average. Why? because a break of these levels often indicates that the fundamental reason for your trade is no longer valid. The stock's trend might be changing. By placing your stop there, you're not just exiting on a random price drop. You're exiting because the chart is telling you that your original thesis is likely wrong. This turns your stop loss from a simple safety measure into an intelligent part of your trading analysis. Let's also talk about the different types of stop loss orders. The most common is a standard stop order, which becomes a market order once your stop price is triggered. This guarantees an exit, but not a specific price, which can be an issue in a fast-moving or gapping market. This is called slippage. An alternative is the stop limit order. This has two prices, the stop price, which triggers the order, and the limit price, which is the worst price you're willing to accept. This protects you from slippage, but it carries the risk that the order might not get filled at all if the price gaps right past your limit. And then there's my personal favorite for locking in profits, the trailing stop. A trailing stop automatically moves up as the price of your stock moves in your favor. You can set it as a fixed dollar amount or a percentage. For example, you might set a 10% trailing stop. If your stock goes from $50 to $60, your stop loss will automatically trail up to $54, 10% below the new high of $60. This allows you to let your winners run while still protecting your downside and locking in profits along the way. It's a fantastic tool for trend-following strategies. Now, let's tie this all together into a complete risk management plan. Your plan should be a written document, a set of rules you live by. It should clearly state 1. Your maximum risk per trade, like the 1% rule. 2. How you will determine your stop-loss placement, based on technical levels. 3. How you will calculate your position size for every single trade. And 4. Under what conditions you will adjust your stop, for example, moving it to break even once the trade has moved a certain amount in your favor. Remember, the goal of risk management isn't to avoid losses altogether. Losses are a natural and unavoidable part of trading. The goal is to ensure that your losses are small and manageable, while your winners are large enough to more than cover them. A well-placed stop loss, combined with smart position sizing, is the foundation of this principle. It removes the guesswork and emotion, turning your trading into a disciplined, business-like operation. It's the difference between gambling and professional speculation. Start implementing these concepts today. Before your next trade, open a notebook or a spreadsheet. Write down your account size. Define your 1% risk in dollars. Analyze the chart to find a logical stop-loss level. Calculate your risk per share, and then determine your exact position size. Go through these steps every single time. It might feel slow at first, but this process will build the discipline and habits that define successful traders. It's the most powerful tool you have to protect your capital and ensure you can stay in the market long enough to become profitable. Thank you so much for watching. I hope this detailed breakdown helps you build a more robust and resilient trading strategy. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you won't miss our next deep dive into the markets. Leave a comment below with your own risk management rules or any questions you have. Stay safe and trade smart.